So just as a quick introduction, I'm Tim Mall from Wellington Management Company, and my role there is to work exclusively on Taft-Hartley benefit plans, which fall a little bit outside of this. So what's interesting from that perspective is I don't deal with the regulations of the sponsorship of these plans. We do work closely with the clients and helping them think about how to resolve some of these issues, though. And as I look at a lot of the things, I read the three papers. Tim's was by far the most interesting, dealing with mass destruction and alien invasions. But another thing, besides a lot of the risks that we're looking at here, when I think about Taft-Hartley's, is that there's a little bit, you talk about the government plans in a lot of the countries, the corporate plans. Taft-Hartley's also have an additional risk, and that is they're not a fallback sponsorship of that plan. So ultimately, a corporation or a government needs to stay solvent. In the case of Taft-Hartley's, it's yet another risk. So some of the questions, just the backdrop, the three things that I think are kind of the overarching themes with regards to the three papers and the backdrop is resilience, solvency, and tail risk with respect to the plans. And then, can they survive another crisis? We've all heard the cliche, the 100-year events are happening every 10 years now. I think that was referenced earlier. In just the last few years, we had the dot-com, the liquidity crisis that, as Tim pointed out, when you look at the ability to recover, as the level of crisis goes down, the amount of recovery time increases, so you have a longer recovery period at the time when demographically you're looking at a lot of baby boomers looking to draw off that pension. And then also posed is, can they survive even in absent a crisis? Jim Volpel at lunch talked about longevity. One of the things that struck me then is if you do end up living to 100, 120, what is your really useful life to contribute into these plans? Can you really contribute to 103 if you're going to retire at 117? I don't know the answer to the productivity at that age, but it strikes me as something that's going to drop off before that time period. That's obviously, as Jim has warned us, in our lifetime, so it's something else to throw in there. And then what if the DB plans don't survive? Obviously, the defined benefit plans is a function of risk sharing to make sure that for the risk of offset of somebody collecting longer is offset by somebody who's not collecting as long. I think about the shift from the DB to the DC is when you're in a DB plan, all the other participants hope you die young so they can take your money. And when you shift to DC, it's just your relatives hope you die young so they can have your money. So that's kind of my look at the differences there. And then the other option is market hedging, which at Wellington we do think a lot about counterparty risk with swaps and things like that. I would be concerned with somebody taking the other side. So if we're insuring longer lives, I'd be concerned with somebody who's betting that a lot of people die quickly. So that's something that I thought was interesting earlier today. Another one thing that Tim brought up in his paper is the alternative to defined benefit plans is, and this is just as concerning, moving in with your kids, providing childcare, and preparing dinner every night. So the options here are, as you can see, becoming more and more grim. But realistically, I think what commonality they had is looking at more realistic expectations for the current pensioners and how they think about their retirement years, and does that need to be altered? With regard to solvency, obviously demographics are not favorable. The risks we've been looking at today are longevity, certainly asset returns, fewer people paying in as the reproductive rates are falling, certainly in the countries that we're looking at. And then interest rate risks, where they are now, makes the plans look underfunded, but as they rise, that creates additional problems of driving down fixed income returns. What contingency plans do we have if they don't? Clearly, there's an offloading of the risk from corporate plans and some government plans with defined contribution. That seems to be one of the largest contingencies. And then what is the role of regulation in maintaining the solvency of these plans? Regulators struggle to find the extreme events. Certainly, it's tough to regulate the last liquidity crisis or the dot-com bursting, things of that nature. And the concern with a lot of these papers is that the regulators tend to be short-sighted in their role of making sure that these plans remain solvent over the long run. They take an annual look, if you will, to make sure that assets, whether it's value at risk, things of that nature, can withstand a shock of the shorter term, which in turn leaves these plans to invest in more of a short-term environment to make sure they're passing these regulator tests, and then don't necessarily have the risk, when you talk about the prudent man to the prudent investor rule, to be able to have a more diverse investments with a longer, hopefully higher return stream. And just thinking about that in 2008, 2009, when we're talking about looking out at the horizon to get the returns you need to support your plans, I can tell you in 2008, a lot of the plans I was dealing with were thinking 30 days to make their next payment because of the illiquidity of some of their asset classes, and then being forced to sell into unfavorable markets for the assets that they did hold that were liquid. So with tail risks, what tail risks are most of them worried about? What tail risks should they be worried about? And then what does tail risk mean for defined contribution? Regulators, as I look through these papers, are primarily concerned with asset liability studies, the risk in the funding. There are many other risks. And then with regards to defined contribution, I wonder that, wow, that went quick. With regards to defined contribution and looking at longevity and informing the population versus the trustees on defined benefit plans, are all defined contribution plans have severe longevity risk, as well as are they underfunded relative to their own individual lives. So I'm going to jump quickly through. You heard probably better from these guys than I'm going to summarize them, but Tim talked about two sets, extreme risks and the sustainability. The concerns there obviously are there risks that we're not addressing that should be addressed? I think certainly some interesting events were listed, but I think thinking about what aren't we thinking about is important. Certainly, no one wants to have extra cash and tell their constituents that we are prepared for a nuclear attack, but we didn't get the returns you needed to retire. Sustainability of the pension system. Tim, and as well as the other ones, painted a picture that the retirement as we know it was never that affordable, certainly as far as our expectations have. So we need to either downscale our expectations or save more than we are at this point. Recovering from extreme shocks, certainly with regards to the longevity of the plan. If something has a longer lifetime, you have more time to recover than if you have a shorter lifetime. Paper 2 by Philip Davis. This was evolution of regulation towards risk, transparency, some of the things the regulators use from their tool set to make sure that plans are funded, risk scoring, stress testing. Important risks are not being addressed by regulations, such as the common theme, longevity risk. And again, the pro-cyclicality of investment behavior that's caused from the regulators thinking about where funds are positioned currently, again, treats them in a fashion that they aren't as prepared for longer-term cyclicality and are more addressed in the short term. Financial education needs to be an important part of what we're doing going forward as we shift from a defined benefit with more possibly sophisticated investors, ideally, for larger defined benefit plans to the individuals and defined contribution plans. Again, regulations can be counterproductive. I think I mentioned that quickly. Value at risk scenarios. One example I thought was interesting is that German defined benefit plans generally have 35% equities to remain solvent. Obviously, that creates concerns with hitting long-term goals. It would in the United States. Paper 3. One of the comments I pulled out of there is most problems in defined benefit plans are not caused by the crisis, but by unsustainable product design and poor risk management. So I thought that was interesting. Either we need to restructure the plans or, again, change our expectations. Need for more uniform regulation in Europe and develop a single labor market. I think that's obviously important as we think about the entire idea of the European Union is to have the synergies of a labor market that can be tapped across it. The multinationals struggle to have different risk and defined benefit plans across the different countries, not just legally but culturally. And then figuring out how we tend to put those together to have a consistent set of liabilities for the companies as well as retirement for the people in Europe. And then, as Stefan pointed out, which in my mind is probably similar in statistical happening as an alien invasion, the politicians in the Netherlands and Sweden got together and addressed a problem before it actually was a problem. That from an American model simply does not happen. We need a crisis, and then it usually happens a good 6 months after that. So again, a structural move of retirement without guarantees, I think, is thematic here. And so the common themes of these, and I think questions that are really not looking to necessarily be answered here, but the sustainability, obviously, the current defined benefit system, shocks that are probably more prevalent than we expect, certainly that we model in. Longevity risk, I continue to hear. Inflation, as we think about the amount of quantitative easing, inflation is probably going to be something we need to be concerned with. I heard that very few corporate plans have any accommodation for inflation. And then the trend of risk transfer from sponsors to beneficiaries. There is some mitigation possibly with insurance companies stepping in, but that opens up the concerns with regards to too big to fail. Some of these derivatives that were designed to help the defined benefit plans also may have contributed to the financial crisis, which then has a synergistic effect downwards on these plans. So what's the right role of regulation? I think that's something that is prevalent among the papers. How do we create regulations such that their interests are aligned with those of the defined benefit plans, and how do we use them to create more realistic expectations of the retirees? And then, so that's a two-edged sword, I thought, when you think about the regulators thinking about these plans. On one hand, they're there to prevent the shocks, to prevent the illiquidity of these plans, but at the same time, as they are doing their job and making sure these are funded, they're also simultaneously, in some cases, preventing the longer view from these investments to have a more diversified risk pool to get the returns that are obviously needed to fund these plans. Right on time.
Perfect.